One thing I mentioned, or very important thing, you guys must know that if you're on day 2, it's fine, but please go watch day 1. It is on my YouTube. This will also go to my YouTube. So I know some of you guys do have some things to do, but not a problem at all. Okay, so let's get started. So once again, welcome to Trading Alchemy, day 2. Let's get into the alchemical forces of supply and demand. So guys, just a disclaimer, as you guys know, trading involves risk. I am partnered with Vault Markets. Vault Markets is a product of First Fintech Capital in South Africa, and we are a licensed FSP with FSP number 51478. So Vault Markets is licensed, and we are regulated. And like I said, trading does involve risk. So everything I teach you guys here, you guys are responsible adults and should make your own responsible trading decisions. And also another thing, I know the topic I'm talking about, the things I will say, might be controversial, but do understand that everything in this presentation, in this session, is purely my views and things that I use to perceive the market. So you can take it with a grain of salt, but if it makes sense to you, it's up to you to implement it. So there we go. Okay, so last week I actually didn't mention this to you guys. I forgot. Now, there's certain laws of alchemy, but we won't be covering all of them. But I'll be covering the ones which I think is most important. Now, also, guys, feel free to ask questions. Let me know if I'm going too fast. Now, the first law I didn't talk about last week is the law of equivalent exchange. Now, humankind cannot gain anything without first giving something in return. To obtain something of equal value must be lost. That is the alchemy's first law of equivalent exchange. In those days, we really believed that to be the world's one and only truth. So power has consistency, power serves a function, and power always comes with a price. So why I mention this is to you guys, because a lot of you guys obviously look up to myself and the way I trade. But how many of you are willing to go through everything I've gone through? How many of you are willing to put in the time that I've put into studying the markets? So a good example of this is if you want a future filled with freedom and time freedom, that means you're going to have to give up some of your time freedom within this current point in time to do something your future self will thank you for. So that is the law of equivalent exchange. There is no such thing as something for nothing. So the law we'll be talking about today is basically correspondence, the law of correspondence, meaning as above, so below. And it refers to the layered structure of the universe, emphasis on the word structure. Now, so for you guys who follow me would know that structure, market structure, is a huge thing when it comes to trading. That immaterial laws rule, so immaterial laws rule matter from above. It also represents things like the idea that we are made in the image of God. Now, I don't mean to sound religious with this. Like I said, this is all my personal views. You can take it with a grain of salt. Further still, it suggests that the purpose of man is to align with that is what is above by transforming himself to be more like that and more able to be channeled, to be able to channel this into his life. Doing so is to participate in the eternal drama of manifesting heaven on earth for yourself. Riyadh, unfortunately, you can't record this message or this video, but it will be recorded by myself and be uploaded to my YouTube. So you'll be able to watch it afterwards. Just check up my WhatsApp afterwards. Then let's now get into the juicy stuff, supply and demand. So it's a very, very simple concept. The amount of sellers equals the supply. The amount of buyers equals the demand. So meaning you only sell from a supply zone and you buy from a demand zone. Traders who understand dynamics of supply and demand are better equipped to understand current and future price movements in the market. Supply and demand is also known as order blocks. So for you guys who maybe have heard of ICT and all these concepts, I always talk about this. Most of these guys teach you the same things, just different terminologies. So an order block is also a supply and demand zone, basically. But it's also very important to note that not all supply and demand zones are valid supply and demand zones. But we will talk about what makes them valid and what not, and how to spot them. So, okay, so the composite man. As you guys know, last week's session, we spoke about the composite man. Now, the composite man drives supply and demand. So the execution of large orders, market makers facilitate the execution of large buy and sell orders from institutional clients such as hedge funds or banks. These orders often result in significant price movements, creating order blocks on the price chart. So usually, so over here, here's your first gem. After a big move in the market, Usually when you see those massive candles, this is when usually an order block or supply and demand zone is formed. Now, manipulation of price levels. Market makers may manipulate price levels to create favorable conditions for their trading activities. This manipulation can involve inducing retail traders to enter or exit positions at a specific price level, contributing to the formation of order blocks as well. So, meaning liquidity. You have to be able to spot liquidity. If you can't spot the liquidity, you will become the liquidity. So identification of liquidity pools, market makers identify areas of liquidity such as support or resistance levels where other significant order blocks are likely to form. And they strategically execute trades to take advantage of these liquidity pools, contributing in the formation of other order blocks. I hope you guys are following me. Like I said in the chat, if any questions you have, feel free to ask me. Okay. So we spoke about this last week as well, just the basics of market structure. So the market does three things. It either goes up, goes down, or it goes sideways. Now over here is that we have an example of consolidation. So usually how do you spot this? Price will be, sorry, there's a mistake here on the chart, eh? This should not be resistance down here. This is my mistake. Let me just try and fix that quickly. Sorry guys, I'm not perfect, not perfect. That's not resistance. Sorry, this is what we call support. My bad, guys. My bad. Just give me a sec. Just want to move this. Oh, no. Okay. So you guys can see it. Obviously, we have support at the bottom, resistance on top. Now, the whole idea, like I said, I'm trying to make it as simple as possible. So when market consolidates, basically means price is ranging, it's going sideways. But the simple term from this is what you should learn from the market structure itself. You always buy low and you always sell high. Think of it, for instance, as anything you would want to do in life. Let's say you want to buy a phone or anything like that. You always want to buy it at the lowest price. And if you want to sell something, you always want to sell it at the highest price possible. Same thing with trading. So when you buy a stock, you want to buy the stock when it's cheap. And when you sell the stock, you want to sell it when it's at its most valuable point in time, basically. Okay, so that is the whole concept of market structure consolidation. And also you always buy from support and you always sell from resistance, but I'm sure you guys know this, but I'm just covering it because sometimes the most simple things make the biggest difference in your trading. Now, like I also said, we also have structure basically where we have market moving in an uptrend or downtrend. So how do you spot if the market is in an uptrend? Now, emphasis on the word characteristics. When you are in an uptrend, the market will show you certain characteristics in order for you to spot whether you're in an up or downtrend. One of these is, so if in an uptrend, the market will always start with a low. So market will always have a high and low, basically. This will also basically go back to the law of correspondence, as above, so below. But you'll see as we progress through the session what I mean by that about the above and below. So in very simple terms, how do you spot uptrend? So market will usually form a high. Then price will pull back, forming a low. Now, when price makes a new high, meaning when it breaks structure, this over here, for instance, this is called a higher high. But now in simple terms, why is it called a higher high? Very simple, because this high over here is higher than this high. So when price pulls back, forming a higher low, and also how you know it's an uptrend is because price hasn't taken out the low at this level. So because price then pulls back, breaking this high at this level, once again, it forms a higher high. Now, obviously, this is a low, but this low is higher than this low over here. So this is why this is called a higher low. Very, very simple if you think about it, right? And then, once again, if price breaks that level, you will have a higher high form. Price will pull back. As long as it doesn't take out this low, price will then form a higher low. And that is the characteristics of an uptrend. Like I said, emphasis on the word characteristic. In a downtrend, very, very similar. Price will always start with a high and price will form a low. Once price has formed a low, price will pull back, forming a new high. Because this high is lower than this high over here, this is why it's called a lower high. So when price takes out this low, price forms a lower low. and price will obviously pull back as well. When price pulls back, forming and doesn't take out this high now is lower than that high. That is why we call it a lower low. And same concept, break to the downside, price will form a lower low, pull back. As long as it doesn't take out this high over here, this will be called a lower high. So just follow me, just in the chat. If you're still following me, just drop a 1 in the chat if you're still following me, because this is very, very important. Okay, awesome, guys. So, meaning, in simple terms, this is how market structure as a whole might look when you open your chart. And also, guys, just a disclaimer as well. This is just an illustration of what price might look like. Obviously, we all know if you look at your chart, it won't always look exactly the same. Okay. So price will always form a high, low, higher high, higher low, higher high, higher low. This is what I want you to understand when I spoke about as above, so below. So basically, you would see that when price broke above this level, it formed a higher high, right? Over here. Now, obviously, we expect price to pull back and not take out this low to potentially form a new higher high, correct? But now we can see that price actually takes out this low, meaning a break of structure. So very, very simple, guys. If we're looking at structure itself, if this is your low, that price lift, this is your last higher low. If price makes a new low, that is obviously called a lower low, right? And what do we know a lower low is part of? It's a characteristic of a downtrend. So once you have a lower low formed, price will then expect to pull back. Now it's all a matter of this zone over here where the price will hold it. And if it doesn't break above and price forms a new break of structure, basically, there you will now have a lower high that is formed and the cycle will continue. Now over here, for instance, you would see price has traded down and here is the last high that price left. Then you can see price takes out that high and moving to the upside, forming this high over here at this level. Now, because price has taken out this high is higher than this high, meaning very simple, that is now a higher high. And we can now expect price to form some sort of uptrend from there. So very simple, price will pull back as long as it doesn't take out this low and it breaks above structure, forming a higher high. This will now be considered your higher low at this level. So that is more or less how market structure as a whole will look like when you are obviously analyzing the market and spotting trend, because also the trend is your friend. And if you know that you are on a downtrend, why should you be looking for buys? And if you know you're in an uptrend, why are you looking for sells? So this is also where FOMO comes in a lot, when people potentially know, okay, I have to see price pull back, but if you know you have a certain bias, stick to that bias and don't trade against it. Okay, so how do we actually spot an order block or supply and demand zone? Okay, now very, very important. Every break of structure, meaning or new higher high or lower low, will form an order block. Now, if you think about it in the sense of like this, let me quickly see if I can't draw it for you. Let's say this is a zone where price consolidates. Sorry, my screen went blank there for a second. Okay, so let's say, for instance, this is a zone where price is trading in and price is doing something like, sorry guys, for some reason my screen is like bugging out here. Okay, there we go. Let's say, for instance, price is doing something like this. That means price is setting highs and lows at this level. Sorry guys, I don't know why my screen is doing this. Just give me a second. Hey, I don't know, eh? For some reason my screen, just give me 1 second quickly, guys. I don't know, for some reason my screen is just black right now. That's very weird. I'm gonna see quickly if I can't do something. Okay, just to confirm me, guys. Can you see my screen? You confirm me if you can see my screen. I'm really sorry about that. Okay. Okay, sorry about that, guys. I don't know why that happened, but luckily I have another screen here. Okay, awesome. So, like I said, every break of structure or new higher high, price will or low price will form an order block. Now, it's important to note that the candle that forms the breakout is a strong volume candle. So, what do I mean by that? Let's say, for instance, we have something like this happening. Let me just grab my annotation tool again. Let's say this is a zone where price consolidates, right? And now market does something like this. Oh no. Okay, so let's say price does this. Price consolidates. What you want to see basically is you want to see price give you a strong candle to the downside, for instance. You want to see price being pushed out of that zone. So you don't want to just see a small breakout candle. You want to see volume push price out of that zone. So how do you actually spot it? I just want to see the chat as well. Okay, there we go. So a bullish order block or demand zone, the way you spot it is the last bearish candle before a bullish move is a bullish order block or demand zone. Don't get confused with that. So a bearish order block or supply zone, how you spot it is the last bullish candle before a bearish move is how you spot a supply and demand zone or supply zone or order block. So technically what you're doing is if you're looking for a demand or bullish movement, you're looking for a bearish candle. So if you're looking for a bearish order block, you're looking for a bullish candle. Does that make sense to you guys? So what I mean by this, so as you can see in this example, when price leaves a break of structure, it will always leave you with an order block, meaning you want to see a candle break out of this zone with a strong zone. You don't want to see such a small candle doing something like that per se. You want to see a strong candle coming out of that zone. We'll talk about characteristics of a valid order block in a second. Oh, just want to cover basically how to spot an order block. And same concept over here. Once price breaks structure, you'll be looking to basically form an order block at this level. And once again, they'll be caused by a candle that pushed out of the zone. And same concept, when price breaks structure over here, you're going to see a strong candle break out of the zone. And there you have your demand zone, basically. Okay, Christopher, I can definitely go back for you. Let me just quickly clean this up. So there you go, Christopher. And anyone else wants to make some notes there? Okay. I feel like I've given you enough time, but like I also said, the video will be recorded, so you can always refer back to it. Okay. So here's a good example of how to spot a supply and demand zone. So over here, you guys can see price has broken above the structure, meaning you can see this candle over here has pushed out of the zone. You can really see over here we have an imbalance, and over here, basically, this is a strong candle out of the zone. So many ways you can perceive this. Just to give you another perspective on that, some people might have even perceived this as the break of structure on that candle, and then this as the confirmation, seeing that that candle also broken above it. But like I said, if you want to spot a demand zone, you want to see price push to the upside, and you want to use the last down candle as your zone. So as you can see, this last down candle over here, here's your demand zone. Notice how price moved up and then came back into the zone. dropped into it, and as you can see, price never came below this wick over here, and there's your move to the upside, basically. So very, very simple to spot that. Let's look at another example of how to spot a supply zone. So supply zone, very, very similar. You want to see price forming breaks of structure. As you can see, price formed a break to the downside, and you'll see it happen with the candle, and price will leave you with a supply zone, basically. With price tapping into that demand or supply zone, this is where you can find the potential opportunity to potentially go to the downside with the market. And same thing, this is the low which price left. If price takes out that low, you want to see price break that with a candle, and that candle will leave you with a supply zone. And once again, look for potential opportunity when price trades back into the level to get into that move and target these lows over here. And same concept will apply when price breaks below this level. Want to see price tap into this new supply zone and then basically just continue the trend to the downside. Here's an example. So here you can see price has traded to the price is clearly bearish, and here you can see price has broken below that level. So you can see price has broken to the downside in a strong move down. Last candle up. That's how you spot your supply. And as you can see, price tapped into that zone, and there is your move to the downside. So just quickly, does this make sense to you guys? Does the concept of how to spot an order block make sense? Don't worry, I know this is purely an illustration as to how to actually spot a zone, but we will obviously go deeper into it to understand how the market makers actually, or the composite man, uses this to his advantage, because like I said, not every supply and demand zone is a valid zone. So also, for instance, the guys who trade smart money concepts or ICT, there's something we call a smart money trap as well, and I'll show you how to spot that. Okay. So the composite man shaping supply and demand. Now, remember, liquidity refers to buyers and sellers in the market. The composite man needs liquidity to enter and exit positions, because remember, wherever there is a buyer, there is a seller, and they trade against us, meaning if we buy, they take the opposite direction, meaning they sell. Okay, awesome, Christopher. I'm very glad, man. So this also goes back to AMD, accumulation, manipulation, distribution. So execution of large orders, we spoke about this now. Market makers basically facilitate the execution of large buy and sell orders from institutional clients such as hedge funds or banks. These orders often result into okay, we spoke about this in a previous slide, basically. Manipulation of price levels as well. Market makers may manipulate price levels to create favorable conditions for their trading activities. Then also the identification of liquidity pools. Market makers will identify areas of liquidity such as support and resistance where these order blocks are likely to basically form. So let's look into a deeper level of that. Now, let's talk about liquidity real quickly. Let's say this is a market we are looking at. So as you guys can see, let me just see if I can draw. Okay. Here we can see the market is clearly moving to the upside. Prices form the high, a low, higher, higher low, higher high. Then we can see over here, break of structure, price forms a lower low. Price has taken out this low. So this now indicates that we are now bearish. Price pulls back. It doesn't take out that high. That confirms that, okay, this is a lower high. Price breaks structure over here, forming a lower low. Forms this level, break of structure, forming a lower low. Price then takes out this low here as well, forming this. Now already now we can see, okay, price is now clearly bearish. Price has flipped from bullish to bearish, and now we can start looking for sells. Now, here you can see, obviously, breaks of structure takes place. Now, here's a supply zone potentially at this level, supply potentially at this level, and here's supply over here. So what you want to go for is you want to go for the most extreme supply and demand zone, okay? And what I mean by that is you don't want to be targeting, because also think of it as premium and discount, okay? Now, I don't have a slide on this on here, but let me quickly give you an idea of what premium discount is. Let's say this is a square, or let's just say this is how the market moved. Let's just do this real quick. Okay, let's say this is the range where price traded in, right? Let's say this is the range where price traded in. Now, if you want to map out more or less 50% of that, let's say more or less something like that, that's more or less 50%. So consider this over here. Consider that this pattern that took place over here, right? So this becomes your entire box basically over here. That becomes your entire box. Now, the idea of premium discount is you always have a discount at the bottom, premium on top. Let me quickly add that as text here for you guys. So this is here's your discount, and then this is your premium. So meaning if you're looking for buys, like I remember I said in the beginning, if you are buying something, you always want to buy at a discounted price. If you sell, you always want to sell at the premium price. So let's say that this is the pattern, meaning you will only start looking for potential sells once price has crossed into the premium of the trend. So automatically we can see from here, if we draw a box down, we can really see this level over here is not premium. That is still in the discount. So to sell at a discount, you're making a loss already, you know? So you don't want to be doing that. Here we can see once again that here's also a zone that price left. This is a zone that could potentially work out. But however, like I said, you also want to be spotting liquidity in the market. Let's quickly clean this up. So what do I mean by liquidity? So let's say, for instance, people who trade support and resistance, right? They always find some sort of zone to explain why price will bounce off here. Now, for instance, we can see price has moved to this level. It rejected. It formed this low. Then price tapped this level and it rejected. And price broke above. So meaning this level over here could now be considered like a support and resistance line. So meaning when price broke above this level, this flipped to support, price came back, now it has flipped to resistance. So this is how they build, this is how they build inducement, because you are taught on Google that if price bounces off resistance and does something like this, you have a double top formation. Now what happens is, with a double top formation, now you have a stop loss above, stop loss above, stop loss above. Now, some people want to see price break above that and flip bullish. What do they have? They have buy stops, and buy stops. And remember, the market, the composite man needs liquidity to enter a position. So what do? They create this pattern, they induce people, and they build liquidity basically. Now what happens is, the composite man wants to sell, right? Because this is a supply level. Also, before we get into that, just some more perspective on this. Let's say, for instance, you are limited with the amount of lots you can trade. Well, we are all limited with the amount of lots we can trade. Let's say, for instance, an institution with, okay, I don't want to meet huge numbers. Let's make it more understandable. Let's say an institution can only place, has 1,000 lots they want to trade, but the limitation on regulation states that you can only place 100 lots, for instance. Now, that will mean that this move over here was caused by 100 lots. So as a trader, if you are entering at this high and you go all the way in profit, why would you come into another trade at this low? It doesn't make sense, right? So for them to enter more, basically, they would have to get buyers at that level. For instance, like I said, they sell 100 lots, they have 900 more lots to go to enter in that position. So what do? Because price has left a high at this level, basically, because here's a high, if price doesn't take out that high, it's still considered a higher low for price to form a potential move to the downside, right? So what happens now is, because they want to sell, they induce people to buy. So what happens, this buy stops. So what do? The people who start buying, they trade against him. And because they need that liquidity, like I said, wherever there's a buyer and a seller, someone's going to be losing money. So what happens is they stop out all these people. That money goes to the liquidity provider. And now they have all these buy stops. Now, before they can sell, what happens is there must be buyers there who they can sell to. Does it make sense? And that's how they get trapped, basically. So you always want to see a liquidity buildup before price hits your supply and demand zone. If you don't have a liquidity buildup, most likely they're going to break through that level. Let's go a bit deeper into that. So for instance, this is what might happen. You might see something like this play out. Price then activates the buy stops. Now everyone is long. Now all those stop losses are now at the bottom of this previous of this resistance that's now turned support basically. And once the market maker or the composite man then gets into that position, he sells, pulling price away from all those buyers. And as you can imagine, then for instance, same concept. Now everyone sees market selling, then they reverse the market and they buy. So as above, so below. Any questions from you guys so far? Let me know if I'm going too fast. Same concept here as well. So let's say, for instance, you have a bullish example. Here you would see, for instance, we have price forming a resistance. So when price traded down, basically when price came to this level, price bounced off the support. Price then broke through the support, forming a resistance. Price broke back above the resistance. That resistance is now support. So as you can see in this example over here, you have a double bottom. So when price comes back there, they will find a way to justify the trade, the retail traders. Stop losses below that level. People also have sell stops there. And the same concept, if they're sellers, they're going to be buying. So what do they do? And also, if you think about what I just explained about premium and discount, if you think about it, the ones who aren't aware of this, they sell in discount and they buy in premium when they should be selling in premium and buying in a discount. So the market is very, very psychological. And if you can't spot liquidity, you will become the liquidity. Okay, let's move a bit forward. Now, remember last week, we spoke about this, these common patterns we see in the market. And this goes back to your 15-minute and your supply and demand zones. This is what I do. So I want to see either one of these patterns also play out before price comes to my supply or demand zone before looking to go long or short. Now, okay, here's some tips from the composite man. Then we'll look at some real world examples on the chart. Now, always take note of your highs and lows, meaning your high and low of the session, your high and low of the day, high and low of the week, high and low of the month, high and low of the quarter, and high and low of the year. Liquidity is always stored at these levels because if you think about it, that high of the day, low of the day, high of the month, low of the month, low of the quarter, high of the quarter, high of the year, low of the year, that will always leave you with, let's say, for instance, let's just make an example. Let's say this is the entire range of, let's say this box represents a session, a day, a week, a month, quarter, and a year. Doesn't matter whether it's any of those ranges because price will have a high and will have a low. That high and low, below there is buyers, that high there is sellers. There's stop losses below, sell stops below. The buyers on top, the sell stops above. Buy stops above and stop losses above. So this is how you can spot liquidity as well. Let me quickly head to the chat and see what questions we have over here. So Devon's asking, the validity of order blocks always confuse you. What is considered a more valid OB than the other? Is the highest, lowest price point? Okay. Okay, Devon, I'll show you that now I'll show you that in the chart in a second. Very interesting question. Very interesting question. Okay, so then also supply and demand zones in most cases will also form above/below these highs and lows. So you will always have liquidity stored and slightly above it a demand zone, a supply zone, slightly below it a demand zone, for instance. So also look for inefficiencies in the markets or liquidity voids, though this can resemble gaps, imbalances, or fair value gaps. Now, these are usually a magnet for price. We will talk about fair value gaps, imbalances in the next sessions moving forward as well, but I'll maybe make an example for you guys when we go to the charts as well. So the composite man will also use news as an excuse to move price based on their targets. This is also how we have mixed outcomes and mixed results, because in the end, The bankers will do whatever they have to do to reach their targets. Money is their religion. Okay. So we've basically gone through the entire theory of the session. Before we move to the charts, everything I've covered now, do you guys have any questions? Feel free to drop your thoughts in the chat. Let's talk about it. I mean, the only way to also learn is, to ask. If you have questions, don't be shy to ask. This is a safe space, and there's no such thing as a dumb question. I always say that the only people who never make mistakes are those who never try anything. G, all good, all good. The video will be recorded and will be on the YouTube. Okay, so let's head over to our charts now. So I just want to confirm with you guys once again. You can see my screen, right? We are now on the charts. We are on GU. Just want to confirm with you guys if you can see my screen before I continue. Okay, awesome. So I actually marked out something very interesting over here. And just to show you guys perspective as well. So basically, I don't know if you guys can see, it is a bit light, these colors, but that's because I don't want it to overpower anything over here. Now we have yellow. Let's actually make it a bit darker. So there's yellow. Yellow represents the yellow represents a new week. The gray lines represent a new month. Okay. So here you can see beginning of a week, beginning of a week. There's something wrong here. So we need one more over here on the Sunday. And we should be good. Okay. Now, first things first. If we just look at, okay, now obviously I have this marked out over here for you you just have to go to the beginning of this month also. So this was the beginning of May. Okay, so here we can see it's the beginning of May. Now, let's quickly focus on this area over here. You can clearly see now, this is the high of May. And this is the low of May, which price has formed over here. You'll see that already have a green candle over there. So I'll just leave that. So here's the high of May. Here's the low of May. Now take very close note of how price manipulates. Let me see over here. This was Friday. This is a new week, Friday, Monday. So just going to go back one more in that week. So this is the last week of May. And just to give you some perspective here real quick. So same thing here at the bottom over here. This would be your low of the week of that last week. And this over here would be the high of that last week. So just notice quickly what price did. Notice how price broke above the high and then came back below it. So your highs and lows is basically how you can spot potential upcoming manipulation. But okay, let's look into structure itself. So here we can see it's the beginning of a new week, and here falls a new month into this week, basically at this level. It came through on a Thursday. So looking at structure itself, also guys, line chart is your friend, hey? If you go on a line chart, you can clearly see the trend. You can see the lower lows, lower highs, and so forth. Okay, let's go back on candles. So by looking at what structure is doing, we can see price forms a low, lower high, lower low, lower high, lower low, lower high, lower low. Now you already have the structure. Okay, now remember also you want to see clean closes of the candle, meaning this candle over here doesn't count because it's only a wick. You want to see price break above this level, for instance, with a clean candle break, like that, for instance, you want to see that candle break above that level with that wick, basically. You want to see a clean break. Then you can see price pulls back a bit. Now, obviously, this is a fractal high, so I'll just move that. Now, here you can see, here we have that clean break of price. Welcome, Vince, welcome. Break of structure. Then what we said, if price is bullish like that, we look for our last down candle. So as you can see, here's the last bearish candle. So there is your supply zone. I mean, sorry, your demand zone. So notice how price steps into the demand and then just moves all the way up into the potential take profit area. Now, same thing, you can then see at this level, price takes out the high, break of structure to the upside. Now, also, let's go back to talking about liquidity quickly. What made this demand zone valid? Now I know I'm on a 4 hour, I'm on a 4 hour chart now, basically, but you can spot it. So notice over here, on a smaller time frame, you would see price come down, form that low, trade up, form this low, trade up. What do we have here? A double bottom, meaning there's people who bought here, which means they had a stop loss slightly below this level. This is why when price came into the demand zone, it took out those buyers and then only left. Okay, now you can see over here, price broke above the level. So what did it leave us with? A demand zone once again. But the question is now, why wasn't this demand zone respected? Why did price break through this demand zone? Well, first things first, we are bullish. So we do expect price to basically react from there. But if you look at the break of structure, there's nothing between this level that made it valid. So if there was something like this, maybe like a double bottom, or if we had like some sort of or if we had some sort of retail pattern, maybe even something like this. Oh, sorry, this is very ugly. But just to give you a perspective, if we could have even like some sort of trend line liquidity that built up below this level, that would have been even more ideal. So there you can see price doesn't hold because there was no liquidity buildup, right? But then also, if you look at from the high to the low, this is the low, here is the high. Notice over here, okay, so price did form in the discount, but then again, like I said, this is where your confluence also plays a role. So there was no liquidity buildup. Price was in the premium, in the discount, but no liquidity buildup. Then you can take it further using a Fibonacci. Now, for instance, my Fib is set on the OTE and the 88%. So the OTE at this level, this is where I wanted to see a reaction. But then obviously, if I have to refine this, I mean, like you can really see that you stopped out. Now notice here, okay, so let me do this. Now remember, there's still a demand zone over here that hasn't been tested yet. Okay, now I know it's a big zone. So what I'll do is I'll just refine it quickly. Okay, so refinement obviously takes place in a smaller time frame. By refining it, this is my demand, and this is where you can see price has lifted. Because once again, also if you look at it from discount and premium standpoint, yes, this was in a discount over here, but this was an even bigger discount they bought it over here. So it was more cost efficient for them to move from that level. Okay, I saw there was a question over here from another thing you want to add is a lot of the time when I post setups, I show it in the 15-minute, 5-minute, 3-minute time frame with my orders visible. Why is that? Do I look for the orders on the 4? Yes. So what I do is I look for my order blocks on the 4-hour, but then let's say my order block is 100 pips. If I go refine it on the 15-minute chart, then maybe it become like 15 pips, then I have a more tighter extreme zone to enter from. And the lowest I refine to is the 15-minute chart. Okay. But yeah. So once again, as you guys can see, then we make a new higher high. And as you can see, that strong push, prices leave us with this demand zone over here. And notice again how prices tapped into it, and why this was also valid is because we actually had liquidity buildup. So here we actually have that trend line action happening, and that's why that move took place. So once again, Here we have a break of structure to the upside. And prices once again left us with a demand zone at this level. So notice this. When price came and tapped into the zone, how price tapped it and then moved to the upside. Okay? But we'll talk about this when we get there in a second. Now, you're still clearly bullish on this move. So obviously here you can see break of structure. Here's your demand. Here's your break of structure at this level. Here's your demand. And once again, like this goes back to all these concepts. Over here, we can see price didn't respect this level, but also once again, question is why it's not. Now here we had that liquidity buildup. We can clearly see that was a nice liquidity buildup, but then also be mindful that you also have this over here, which is also liquidity on smaller time frames. Okay. Yes. So the key to that order blocks will be to look for liquidity buildups. Yes, that's correct. Then, so you can see then over here, when price tapped into this level, how you had the reaction. Now, guys, also just a disclaimer on this. It won't always be perfect. I'm just literally giving an illustration of how the market will look. This is only day 2 of trading Alchemy. We will go deeper into things with like more advanced concepts, refining on smaller time frames. For now, like purely just get the idea of like the composite man, supply and demand. Okay, we'll talk about that next week. I'll go deeper into it. Now, a very, very important thing to also take note of over here is over here basically is when price broke below this level. Price technically formed a lower low. Now, be mindful that price also left with the supply zone over here. So notice how the supply zone also had a reaction. So the whole thing becomes reacting zone to zone. So for instance, you would have a demand zone at this level. Here you can see liquidity buildup. But then once again, for instance, on a smaller time frame, this would be internal break of structure, and this would be an internal demand zone. And once again, as you can see, there's that push to the upside. And same concept, price has left you with supply zones at these levels. For instance, here's another one. It's a bit big, but I haven't refined it. But obviously, if I refine it, you'll see something like potentially that. And notice that spike in there and drop. So literally, guys, it becomes this whole thing of just spotting where the liquidity is sitting and trading zone to zone. So a very simple example I can make of this is, let's say, for instance, this is what the market did. Say the market did something like this. And let's say there was a demand zone at this level. Let's say there was a demand here. And let's say there was a supply zone here. Literally, as long as price is over here, I'm not trading it. When price reaches this demand, I will look for my buys. If it doesn't go there and it goes up, when it comes to my supply, I look for my sells. So there's literally nothing to force because you can't, like I said, you can't determine. You're not the market maker. You know, you have to wait for them to show us their hand. So let's quickly just go dive a bit deeper into this. You can see over here, break of structure to the upside once again. Here's the demand, price lift. So price almost tapped that. So this would have been a missed position, unfortunately. But once again, price has broken to the upside. As you can see here at this level, there is your break. And price has left you with the demand zone once again at this level. And once again, as price taps into it, there you have the reaction. But also take note, when price took out this low over here, this is when you had a change in trend. So then what caused that break of structure to start taking place? We had a supply zone at this level. And notice that tap into that zone and drop. And what do we have? Nice liquidity buildup. Go practice it, guys. Literally, what I'm doing here, I'm just running you guys through all the zones I'm seeing and what I would have taken. But literally, go and backtest it. You can see even this demand zone we mapped out. Notice how price tapped it and why. Once again, there's liquidity over here. Tapped into it, tapped into it, So once again, you can see over here, you have the double bottom liquidity. The demand zone down here, what happened? Price tapped into it, rose, but because you are now in a downtrend based on change of character, here was your last supply zone. Tapped it and dropped. So another good example was break of structure. So price left you with the supply. Okay, price never came back there. Break of structure, supply. There you can see price almost tapped it as well. But yeah, it's literally all a matter of refining. So Kiara, where would your stop loss and take profit be? So once again, just an illustration. Let's say for instance, this was your zone basically. You would want to enter at the high of the zone or 50%. Stop loss slightly below the box, targeting the opposite liquidity. So if you bought it from this level, that would have been your trade, for instance, risk reward of 1 to 5. And to sell, for instance, then stop above the box, and you'll be targeting the opposite liquidity and potentially have another TP at the unmitigated demand zone. So that would be how it potentially should be. But then let's quickly talk about zone refinement. Let's quickly make an example of that. Let me go a bit further into time. Let me just make an example real quick. So once again, let's say for instance, I'll make a good example because now, okay. Also, guys, this comes with experience. So I have done this for a long time. So like I know what to look out for. So this wick over here is technically a demand zone, right? But like I said, this is just an example to show you guys how to refine a box. Let's even say this was your demand zone over here, that last down candle, right? If I go and my 15-minute chart, now I refine it, I simply look for the same thing. So you would see this is when price broke out of the box. Here's my last down candle. So when price taps into this box over here, I can potentially look to go along on GU. Okay, guys. Quick question. Vince, the Asian range has its own specific method that we approach it with. So if I haven't mentioned it on here, then no. The only time you consider the Asian range, let's say for instance now, a good example, Vince. Let's say for instance now I'm checking my charts, looking at my 4-hour. Now I can see here's the demand zone. So what I then do is I flip my 15-minute, then I go refine it. Once I have my zone, now I'm on the 15-minute chart. Now automatically I have my Asian range. So what happens now? If price breaks below my Asian box, like we explained, we look for buys. So very, very simple. So you'll only implement your Asian box once you flip to your 15-minute chart. If you're going to have everything on one chart in your 4-hour, your charts will look very, very messy. Okay, guys, from your side, any questions you guys have? How was the session? Did it make sense? I feel like could have done better, but also it's putting it together for you guys. It's really not easy trying to explain these concepts, you know? But I always try and do my best for you guys. And if it wasn't the best I could, like I said, there's much, much more coming. I can only improve with my teaching, the information, and so forth. So yeah, great, man. Great. I love the fact that you guys loved it. Okay. So also, guys, remember. Thank you, Vince. Thank you. So also, guys, remember, I'm here to help. I'm here to help whoever is willing to help themselves. So if you want to go and practice this and so forth, do analysis, feel free to do your analysis, send it to me. Even if you're not a client of mine. Now, also disclaimer, if you're not a client of mine, you obviously don't have the priority of my response, you know. But when I do have time and I can respond to you, you obviously have the opportunity for me to check your analysis. And I will tell you, okay, no, I wouldn't do that. Or I will tell you that looks perfect. Keep on doing what you're doing. And also, like by sending, for instance, myself, this goes back to why it's important having a mentor. A mentor will hold you accountable. A good example of this is when I blow my account, for instance, or not when I blow my account, when I blew an account once, I asked my mentor, but I don't understand. I did this, what you did. But then he asked me, did I teach you this as in my course? And I said, no, because I wasn't at that level yet. And he said, exactly. So having a mentor will hold you accountable. So if you just go look at this and you don't ask for help, you're just gonna discourage yourself if you do go wrong. But if you ask me for help and I can say, oh, but you were right, it's just maybe this candle here you overlooked, things like that. The smallest things make the biggest difference in your trading. So I'm very, very happy for everyone who joined us. I'm very okay, awesome, man. Okay, I'm really glad you guys enjoy it. Like I said, I love teaching you guys. I love seeing the progress. So next week, same time, 1 o'clock, day 3. We'll talk about entries and exits. So now you know how the Asian session works. You know how to spot supply and demand zones. Now let's talk about next week how I actually enter my positions, where I exit them, how I manage my risk, how I manage my trades itself, and how I set up my watch list. And then in day 4, we will basically cover everything we've gone through, cover some more questions, and just add some more gems for you guys, And as time progresses, moving into March, I'll be dropping some more gems for you guys. So I'll see you guys next time. And like I said, you guys know how to reach me. Please like and subscribe to my YouTube channel. I really appreciate it. I'll see you guys next time.